Welcome to the Bulllington Capital Report, hosted by Bill Bulllington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bulllington.
And welcome back. It has been an interesting week, to say the least. And what I'm talking about is I was at a conference that went, this is a whirlwind. I left on Wednesday, got to Austin, Texas, met Wednesday night, all day Thursday. Actually left, met with a professor from the University of Dallas Thursday night, came back yesterday morning. Woohoo! I thought I was too old for that. But anyway, it was a lot of fun. And the only reason it was fun was because I'm sure most people thought it was really boring. But the data that I was able to gather from one of the largest money managers and one of the largest providers of exchange-traded funds, it's not all they do. They do a lot of other things too, but they're one of the largest in that category, who doesn't advertise. This firm doesn't advertise to the general public. They basically provide research to people like me. And they've got, there are a couple of economists that you've seen on CNBC. One of them actually held a very high position in the United States government at one point in time and still talks to people like the treasurer, Mnuchin. So they still have contacts. And that's really interesting. That's what I really like to know, which is essentially why I went to the conference, was to be able to get to hear these guys speaking out. I was so lucky. I ended up sitting at one of the dinner tables with that guy. So that was pretty cool. And I got to tell you, I've got a lot of information, a lot of material. I'm going to bring it with me to the seminar that we're having. And I'm so excited. I forgot to look up so I can give you the date. But so we're having a seminar. It's coming up pretty quickly. And let me see. I think it's November 2nd. Yes, it is November 2nd. And it's going to start at 6:30. We're going to do a couple different things because the primary topic was socially responsible investing, and we got a lot of great material for that too. Does that progressed a long way. It's mind-boggling how much that space has grown and how well those funds have done. I'm amazed. Because when they first started out, they weren't doing so well. But boy, have they closed the gap. That's amazing. I mean, they were really getting beat. And then the past few years, not only have they caught up, but a lot of times they've been outperforming. So very interesting. Socially responsible investing. Can you make money and be a socially responsible investor at the same time? So we're going to take a look at that. But then we're also going to look at one of the reasons why the stock market's done so well and why this bull market's probably going to be the longest bull market in the history of the country. Yep, this bull market probably, that doesn't mean you don't have a correction. 10 to 15% corrections, by the way, don't count. 10 or 15%. And I know a lot of people are probably a little upset by that, but a 10 to 15% correction doesn't count. A big correction is anything over 25%. Okay, you get over 25% correction, that's considered a bear market. Okay. And I just, after talking with these guys, keeping up with the economic data, they pointed out some things. And listen, this is all these guys do. That's all they do. Their reason for being on this planet is to analyze economic data, go out and share their opinions and the data. So that's all they do. And they've got a lot more time to be able to do that than I do. And they have a lot more connections than I do. So that's why I went. And they were sharing the information that they found with us. And this is just fascinating. I mean, some of the things that they had pointed out, I knew the economy was strong. I had no idea just how strong. By the way, driving from Austin, Texas to Dallas, it's about a 3.5-hour drive. They were building the entire way. That entire state is under construction, and not because of the hurricane. And by the way, the hurricanes, the impact on that is not going to be that significant. In fact, it'll actually spur more economic growth because insurance companies are going to pay. What's what they do. That's why they're in the business. They know they're going to have these events every once in a while. They build it in their premiums. And if they underestimate it, they'll just raise premiums and make the money back. It's kind of how that works. That's a good thing. It's actually a beautiful thing. Works very well. And you add that to the growth in that state and all across the country. I mean, you're looking down, and it's just amazing. I think it's an amazing time to be alive, quite frankly. And you look at some of the numbers that these guys were talking about that I wouldn't have the time to find on my own because they're so difficult to do. Like a tier 1 capital ratio of all the banks in the S&P 500. We've got plenty of time for that, right? So, that's hard. That finding those numbers to begin with is relatively difficult. Then limiting them to just the stocks that are in the S&P 500, that is a lot of effort, a lot of labor. So anyway, I didn't have to do that because they gave it to me. And the tier 1 capital ratio, that's a number that they feel like is very important, kind of a gauge of how economically healthy a bank is, financially healthy. And the tier 1 ratios, they go all the way back to 2003 when they're 8.6, 8.5, 8.3. That was their tier 1 capital ratio. Drops down in 2007 to 7.5. Okay, that's a big drop, by the way. The little tiny movements in stuff like that makes a big splash in other places. You'll remember that was the economic malaise, the beginning of it. So today, the tier 1 capital ratios of the S&P 500 banks is 13.5, 13.5. That's almost twice. What does that mean? Well, it means they're much better prepared to weather the next storm whenever it comes. Because it's not a matter of if it's going to come, they come. Trying to predict it, very difficult. When I say very difficult, it's like picking anything else that's relatively random. So it's extremely difficult. We're nearly twice as well capitalized from that standpoint as we were back before the economy hit the skids. So that's a very good thing. They went through a whole ton of different things with the banking, particularly banking and financial. Why are they focusing on that? Well, something that we've talked about here for quite a while. If the banks are having problems, so is everybody else. If the banks have problems, the bank starts sneezing, everybody else catches a cold. Sometimes they get the flu. The banks are the backbone of the economy. They are. Okay, so if they start having problems, then everything else starts having problems because it's hard to get financed. Most people don't pay cash for everything. I'm looking at moving and upgrading my offices. Don't panic. I'm only moving it a mile away. But instead of writing a check for that, I'm probably going to finance it. It just makes it easier, a lot easier on the cash flow, especially. But if the banks weren't available, or if they were saying, "Hey, we like your business, Bill. We're just not taking any new loans on right now," I go, "Oh, well, maybe I hang out till next year." Or maybe I have to stick into go into my savings instead of taking out a loan for the bank. So that's and then I start looking really hard. And do I really want that extra computer over? No, I'm just kidding. Actually not, but because that's actually what happens. And so the banks are the backbone of the economy, and there are a ton of really nice data points that these guys put together about how healthy the banks actually are. And by the way, they're not Pollyanna. They talked about where the potential problems are, because there's always problems. I mean, there's always threats. There's always some sort of risk that you're facing. And they talked about that too. And so I'm going to share that with everybody that comes to the seminar November 2nd. I'm going to package this up for you and let you take it home. And we'll flip through some of the pages really quickly. I'm going to particularly take the pages from the ones that I thought were most important and or going to have the biggest impact. And I think you'll be really, really surprised. It's probably going to be one of my better seminars in a long time. So you can sign up for free. It's bullingtoncapital.com. It's going to be November 2nd, 6:30. And by the way, I won't be on the air next week. I'm getting bumped. There's a football program. I'm going to be on really early in the morning. I think around 7 o'clock. So, because I got bumped by a football game. And that's just the way life goes. So I'll be on very early next week, 7 o'clock. You might want to listen for that then. And we'll talk a little bit more in detail about this. And also at the workshop, and I didn't put this down on the website, but last time I had a little technical difficulties, so I couldn't complete the 10-minute retirement plan. So we're going to take another shot at that. It's actually very simple. And I'm going to show you a service that we're providing. And I'm going to bring a spreadsheet with me with a couple formulas that you can use to replicate this stuff on your own at home. So that's what I decided to do. Instead of using the high-tech route, which, when technology is great as long as it's working, when it's not working, not so much. So I'm going to show you how you can do this kind of stuff, how you can come up with what type of retirement you could be looking forward to based on your current savings and your income needs. And it's really not that tough, especially when you've been doing it as long as I have. So we'll talk about that again at that upcoming seminar too. I think it's going to be, that's only 10 or 15 minutes. The tools that we're using through Bulllington Capital, we have a service that we're providing people that you can go in and there's a retirement planner on there. If you don't have time to call me up, and you're a client of mine, you can actually log on and they have instructional videos on the website about how to use it. So, and once you get used to it, it's really not that difficult. I will tell you that there's one area of it that I probably have to point out and kind of walk people through, at least the first time, that to make it more accurate. So, but pretty much you can figure it out, probably 98% of it on your own. And the other 2%, it's not going to be, if you did get stuck on that part, the fix is really easy. What you have to do, you have to make an adjustment. And I know I'm probably losing everybody by talking about this in such detail, so I'll stop now. If you'd like to call, ask any questions, 216-901-0945, 216-901-0945. But I just have to tell you that the economy is a lot stronger than we're being led to believe. And I know everybody's talking about a correction, because it hasn't come for a very long time. Well, guess what? If corrections came on a calendar, I wouldn't have a job. If you could predict exactly when these are going to come by looking at the calendar, by looking at how many years it's been since the last one, nobody'd ever need to work. You would just buy stocks when the time was good, sell them when it was bad, and, just live off your profits, and no one would ever have to work. So the fact that it doesn't work that way doesn't mean you should throw your hands up in the air or try it anyway. Those are the two most common responses. I can't do it, just throw my hands up in the air, and or I'm going to try and time it up anyway. There are solutions. There are lots of solutions. I think a lot of them make a whole lot of sense. And again, the kind of stuff that we'll talk about here, I'm really excited about working the upcoming year, and we're getting close. It's hard to believe it's halfway through October already. Yeah, that's kind of mind-boggling. Halfway through, we're 3/4 of the way. I just keep forgetting how fast time is going. So anyway, I'm really excited about the state of the economy. Are there problems? Sure, there are problems. There are always going to be problems, but these are manageable. These are manageable problems. That's what's really exciting. Some of the other problems we've had in the past, they were manageable as well, but there was no cooperation to get anything done. And as much as things are in that same kind of state now where they keep arguing about things, they're still getting more things done. And what's really important is that the big businesses are spending money again. The big businesses are spending money again for the first time in an extremely long time. Revenues on the S&P 500 were up over 5% year over year. Let me say that again. Revenues were up over 5% year over year. You know how long it's been since that's happened? It's about 9 years. And that's a beautiful thing. If you want to make something really simple, okay, say take 5% growth in revenues, which typically grows profits faster. Profits tend to grow faster than revenues do. Why? Because your fixed costs remain fixed. Like you don't automatically buy another building just because your sales went up. Now you might do that 3 or 4 years from now if you keep experiencing that growth. But generally, when your sales go up, your fixed costs remain relatively fixed. That's why they call them fixed costs. And your profits go up faster. So that's really cool. So if earnings are going to be up 10% or so, and you have a dividend that's around 1.5 to 2%, that's not bad. That's actually very good. And now you get some of the categories that have been lagging for the last 5 or 6 years. Once they start to kick in, we should be cooking with gas. This is, I'm really excited about it. Probably more so than I've been in a very long time, which is really weird because this is, most people are talking about the end of the bull. Sorry. Yeah, I don't think it's ending. Not yet. Are you going to have corrections? Heck yeah, that's just part of being in the stock market. But but I think the stock markets typically do fairly well under the existing economic conditions whenever they've existed in the past. And we've got an awful lot of things going for us. A lot of them have to do with new technologies, innovations that are coming, that have come, that are now being employed. And it's amazing. I guess the old saying, nothing is as constant as change. I wonder whose saying that is. Yeah. Nothing is as constant as change. That's absolutely true. And a lot of the changes that we're seeing now are going to grow and expand the economy. And it's not at the expense of a lot of other things. A lot of the old things are going to hang around for a long time, but the growth is actually going to come from other areas. It is coming from other areas. And I can't see that not continuing. So it's really a good time to be around. It's a good time to have a diversified portfolio. I don't think it's as important. I don't think it's more important than it is today, because one of the other things that that we see that I'd like to talk about when we come back from a commercial break, if we ever take one. Anyway, we'll have a commercial break sooner or later. 216-901-0945 if you have a question you'd like to talk about this in more detail. Again, I really am super excited. I think a lot of changes are coming, good positive changes, and we'll talk a little bit more about what those other changes are right after these commercial messages. You're listening to Bill Bulllington right here on 1420. Stay tuned.
The best things in life are free.
And we're back, and I have to go to the phones right now. I have Paula on. Hey, Paula, how are you?
Fine, how are you?
Oh, pretty good. Yeah, haven't heard your voice for a long time.
I know. It's been quite a while. I just wanted you to speak generally about the changes that you've been making within your investment strategies. I know that something happened a couple months ago where you did have to switch models, and I know that it's specific to me. Maybe my question's too specific, I don't know. But I wanted to just talk generally about the new investment model that you're using.
Sure.
Which kind of pulled away from the Fidelity funds and kind of diversified into a lot of funds I've never heard of. So
yeah, actually, reason you haven't heard of them is because they're only about 6 years old.
Okay.
And the Department of Labor came out with some rules. They said you've got to diversify in these other areas, and it was actually good timing because what they did was force us to hold some other asset classes that really didn't do too well for the past 5 years. They were either flat or negative, and then this year they're actually the best performing. So adding that at that time, that was sheer luck to that particular model. So we have large cap, mid cap, and small cap. Those are large companies, medium-sized companies, small companies. We have international and emerging markets. And what I did was I went through a program to become an accredited investment fiduciary, because these guys have this database that you have to have that designation to be able to access. So they have the database that measures a lot more than just the performance of a fund. It measures the risk. It's got all kinds of stuff in it, and you can program it and pull out just the types of funds that you're looking for. So this is what I did. I went in each of those categories that the Department of Labor said, okay, you guys have to keep some X amount of dollars in each one of these from now on. And by the way, they pulled that rule back at some point in time. There, it'll actually get passed. But so we're just preparing for that in the future, and it's a good idea anyway. So I took went through the database, pulled out the ones that had the best risk-adjusted performance. It's great to have performance, but if you're taking too much risk, one day that shows up in rapidly dropping share prices.
Right.
So I took the best risk-adjusted performance, and I used the ones with the lowest expense ratios to be able to put that portfolio together. So it was actually it was a lot of effort, and we still continue to look at that thing. I like the fact that now we've got exposure in the emerging markets, which has been up the most this year of any of the categories, after lagging for like 5 years in a row. And international's doing very well. Their valuations are lower than ours are in this country, and a lot of their companies are growing faster than ours are. Sooner or later, that matters. Sooner or later, it looks like now is the sooner. It looks like they've finally started to come around and are starting to participate in the rally, 4 or 5 years after the United States has already started. So that's a good thing. That's a really good thing. And I love it. I have it personally in my own portfolio. I do the other things too, but they're not. This is where I have most of my money now, most of my stock money, and it's in those funds. Their expense ratios are super low. I mean, super low, and I just think it's the way to go going forward. So, and we really should get together.
We do, and I know we tried. Yeah. And I'm still trying to carve out some time for that, because I definitely need to work on some future plans. So
yes. Yep.
I will call you.
And, okay, we sent you that invitation to that service that we're providing on the internet, because I want to show you how that works. That is really cool. You'll really like that a lot. It's free.
Oh, that was the one you were speaking of a few minutes ago?
Yep. Yeah.
With 98% intuitive and 2% maybe not so?
Yeah. Yeah. Well, you're a good listener. You got a great memory. Yeah, that's awesome.
It was only 10 minutes ago, Bill.
Well, that's awesome. Hey, is there anything else we can do this morning?
No, that's it for today. I was just kind of wondering that, and I was kind of amazed that none of the other funds showed up in this list, and so I was just kind of questioning it myself. That's all.
Yeah.
And since I had you on the radio, and I thought, I'll give him a call.
Yeah, great. That's awesome. Well, all right. Well, I appreciate it, and I'll reach out again this week. We'll get you on a schedule here so we can get that done.
That sounds good.
All right. Well, have a happy Sweetest Day, and have a happy weekend.
Thank you. You too. Take care.
Thanks. Bye-bye.
Bye-bye.
Yeah, it's pretty cool. So what she was talking about is a model that I built because of the Department of Labor. And you know what? I really think it was a great idea. I know it was. U.S. large cap stocks, basically S&P 500, have beaten just about everything on the planet for 5 years now. 5 years, over the past 5 years, best performing asset class up to January. Then that started to change. And a lot of these other companies, and by the way, do you know a company called LG Electronics? How about Samsung? How about Toyota? Do you know those names? Those are major names in those emerging markets and international indexes. And they haven't done quite as well as companies here have. So, or many of them haven't. And that's one of the reasons that I think that was very good timing on the part of the Department of Labor, which turned out to be just luck. And by the way, they delayed implementing that rule. Eventually, it's going to get done. They came out in 2006, with a very similar rule. And they were going to enforce it back then. We were going to have to hold various asset classes. Basically, what they want us to do is run the money the way that big pension plans run theirs, which is not a bad idea. A big pension plan runs its money as conservatively as possible. Notice I didn't say completely conservative, as conservatively as possible. Okay. So take a look at the amount of risk they're taking, what kind of returns they think they can get, and they monitor those things on an ongoing basis. And they make adjustments from time to time. So basically, we're doing the same thing that big institutions do. And It's kind of expensive, by the way. The software is really expensive to run those types of screens. The vast majority of people have a tendency just to run the best performers. Well, I got to tell you that I used to do the same thing when I was young. The best performers are not always the ones that are actually more often than not, they took a lot of risk and it paid off. So you get a fund that's got a great 1-year track record. Its 3 and 5 year track record is going to be lifted because of how it did in the past year. And oftentimes that doesn't repeat. In fact, there are lots of times when that thing crashes and it goes back to the bottom of the pile. So that's a really dangerous way to select your investments. What's got the best 1, 3, 5 year track record? You have to look further into it than that. That's an okay starting place, but that's not where you want to finish. And again, we'll talk about that kind of stuff too. And quite frankly, small caps should be significantly higher than they are. Financial stocks, they should be, on a valuation basis, they're still lower. And since I brought that up, I want to tell you about a thing I'm going to spend 5 minutes on at the seminar, literally just 5 minutes, because that's as difficult as this needs to get. When you're looking at a mutual fund, pull up the top holdings in it if you're interested, if you've got time to kill. Pull up the top holding in that mutual fund and find out what the earnings yields are on the top 10 stocks in that portfolio, because the top 10 stocks will typically make up somewhere between 20 and 30% of the fund. So this is how you can kind of tell what kind of risk they're taking. And an earnings yield is just taking the earnings, the profits that companies earn over the past 12 months and dividing it by the share price. It's kind of like converting it to a CD. If I were the owner of a company, I would want to know what kind of earnings that company's had before I made an offer to pay for it. And if I looked at the earnings yield, and let's take a hypothetical example. So I've got a company $100 a share, and their profits over the past 12 months were $5. Okay? That's 5%. I keep the math easy, especially when I'm on the radio. But the 5% earnings yield. Okay, so if you see a company that's got a 5%, in other words, if you own that company, you'd be keeping 5% after taxes, incidentally. If you paid it out as a dividend, you'd actually have to pay taxes on it. So that's why we use the earnings yield the way we do. I don't want to bore anybody here, and I'm just going to kind of keep moving on. We can debate all these things in private later, but it gives you a very good basic measure of whether or not a company may or may not be overpriced. So if you look at the earnings yield, now you can compare one stock against another to see which one's giving the best deal, at least on a financial basis, at least over the last 12 months. Now, that's not where you want to stop, by the way, but it is where you want to begin. Take a look at the earnings yield. And it's funny, I've been talking about that for, I don't know, probably 20 years. And I think if the industry itself spoke in those same terms, earnings yield, let's use earnings yield. Let's pull up Procter & Gamble. So Procter & Gamble's got a market value, $225 billion. And they had earnings, $5.6 billion. That's the trailing 12 months. Now, that may be high or low. We don't know that yet. Okay, that will come further on. But if you divide 5 by 225, it's a little over 2%. 5.6 billion, a little over 2%. So the earnings yield on Procter & Gamble is a little over 2%. Is that good? Nah, it's not that good. Is it? That's because the share price is actually not too far off its all-time high. So if I looked at Procter & Gamble and I said, 2%, man, I can get a treasury or a CD that's paying close to 2% now. I think I'd rather have the treasury. So, which is really funny because their dividend yield going forward. And by the way, this is really dangerous. What I just did is really dangerous because I only looked at one 12-month time period. And actually, I looked at the wrong column, by the way. It's not 5.6 million. It's 15 billion. Oh, geez. I need to wear my glasses. The net income was 15 billion. I'm sorry. So that's actually more like 7.5. Suddenly, Procter & Gamble looks a whole lot better. So 7.5% earnings yield. And I look at that now and say, oh, okay, that's actually pretty good. That's pretty good. It's not bad. It could still go down 40 or 50%. Why? Because it's a stock, and that's what stocks do. You go down 40 or 50% sometimes. But you've got a net income. Now, I'll have to take a look at that net income number and the profit margins, and I'll look at the history of that company to see what is. By the way, it was down 3.65% on Friday. So it dropped 3.6% on Friday. Okay, and after just recently just making an all-time high. Dividend yields on it is 3%, which is not bad. And when you look at what they do, I look at that and go, oh, you know what? It actually makes sense to have as a portion of a portfolio. It's one of the most widely held stocks. It's in a couple of the portfolios that I manage, and it's in a couple of the ETFs that we picked. So we have exposure there, and that's pretty good. Let's take, and I love to pick on Facebook, but I know I shouldn't. Facebook has a $500 billion market value. Their revenue was $33 billion, and their net income was $13 billion. 13 equals what percent of 500? I don't know. How many times does that go into? It's about 2%. Yeah, a little over 2%. So here, this is a good example. If you earned all the shares of Facebook, you'd be making 2% on your money if you got to keep the net after-tax profits. 2%. So 2%, kind of low, but their revenue growth last quarter was 44%. So people are obviously thinking that, well, they're probably going to keep growing for a while, so I'll take 2% today because I think it's going to be 4% 24 months from now. I think the profits are going to double. And then I think the profits might even double again. So 10 years from now, I think this stock might be selling for $350. It's selling for $174. It might be selling for twice or maybe even $500. And they're willing to wait. They're willing to wait that long. Now, if in the meantime that growth rate slows down, that share price is going to crash. It's not going to drop. It's going to crash because it has to maintain that growth rate to be worth what people are paying for it today. Okay, it's got to maintain that growth rate for the next 3 or 4 years. And I don't know, man, when you're doing $33 billion in revenue to grow your company by half, that means you got to pick up an extra $15 billion in the next 12 months. Okay, in my opinion, that's a long shot. I'd rather have Procter & Gamble rather than Facebook. Now, this is what every portfolio manager on the planet has to do. They have to make these calls. They have to figure out where they think the better deals are, where they think the stocks are going to be 4 or 5 years from now, not in the next 6 months. That's what your average portfolio manager does. And then you've got a lot of people like the people at First Trust who do a lot of the things that I do, and we just have checklists. We're called quants. We have checklists. If the stock meets the criteria, it gets to stay. If it doesn't meet the criteria, it's gone. And that's a very popular form of investing because it's very non-emotional. And I hear the music. That means we're coming up to another commercial break. If you'd like to call us, 216-901-0945. You're listening to Bill Bulllington right here on 1420 The Answer. Stay tuned. Wow, I remember that. We used to use that when I first started doing this show. That was in 1996, by the way. The long time. The longest running financial talk show in Cleveland. Now, Jim might argue with that, but he wasn't doing the show back then. But anyway, so yeah, I'll give it to Jim because he was married to Tam. I don't know if you know that history. I'll quit talking about that. I know people don't really want to hear about that that much anyway. What they do want to hear about are the economic statistics that really support why this is not the end of the bull market. And I think it's amazing. We live in such amazing times. We've been setting records in all kinds of areas. It's mind-boggling. And I'm so glad for my kids and my grandkids. I got 4 grandkids. One's on the way. I'm excited for these guys. They're smart. These kids are growing up with technology, and they know how to use it right away. It's not foreign to them. They adapt extremely well. They're a lot smarter than I am, that's for sure. I talk to my 4-year-old grandkids. I feel really bad for myself. Wow, I couldn't say that stuff when I was their age, but I had no idea what it was. Anyway, here's a very interesting statistic. And by the way, I'm going to bring these with me printed out. It's probably going to cost me $300 or $400 minimally just to print this stuff copy this stuff at Kinko's. Not $300 or $400 per person, but just for the seminar. Anyway, real business investment as a percent of GDP. So whenever you hear the word real, that means it's been adjusted for inflation. Okay, so real just means adjusted for inflation. So if you look at how much money's been spent as a percent of our output for the entire country, that's what GDP is. Okay, as a percentage, it's actually at its highest levels ever. Think about that for a second. The businesses are spending, they're investing, they want to grow. You know why they want to grow? Because the people that invest and work at those companies, they typically get stock in the company. The board of directors wants to do a good job. The CEO's his reputation's on the line. And by the way, his compensation depends on how well that company does. So they're going to they're reinvesting. Now, this is relatively new. I mean, the reinvestment prior to a couple of years ago was horrendous. They weren't reinvesting. They were buying shares back. That's what they were doing. They were buying shares back, which drives up the earnings per share without any real growth. Okay? So if that doesn't mean anything to you because you're driving and you can't really, don't worry about it. Just know that a good thing is happening. That's what you need to keep in mind. And that's really a good statistic. So again, I'm going to make some copies of these and I'm going to bring them with me to that seminar and you'll get a copy of this. So after the seminar, I may post it up on my website. I haven't figured that out yet. I have to get permission from First Trust. Anyway, another statistic I thought was really fascinating. They were talking about Moore's Law. Moore's Law, that nobody's talked about that in years. That was the processors used to basically double their capacity every 6 months or so. And the prices kept coming down. And they're talking about now, they pointed out that the cost per genome, you know how they match or map the DNA, so they kind of tell all kinds of, they make it use medicines, whether they use it in medicine and medical practices. Anyway, the cost per genome in 2001, it was $100 million to do that one time because the technology was incredibly new and very expensive. Yeah, is that 100 million? Yeah, 100 million bucks. It's come down to $1,000. How'd you like to be in that business? Talk about price pressure. Holy cow. So it's driven down the cost to $1,000 from $100 million. That is mind-boggling. So if you want to see that, and here's what they had to say about it. The cost per genome represents the dollar cost associated with the DNA sequencing of one human-sized genome. Moore's Law, they were comparing it to Moore's Law, by the way. Moore's Law that the increases in capacity for a chip increases what it can do, so the cost per operations is actually lower. The bigger, the faster the chip is, the less time it takes, so the more cost savings you have. Anyway, the cost on that has dropped, but nowhere near the way that costing or mapping a genome has dropped in price. So I just thought that was a really interesting thing. Here's another thing that's really good. A lot of people don't realize that government spending makes up a huge percent of gross domestic product or output. And military has been an extremely high percentage of that in the past. And in many cases was the single, before they created Medicare, was the single largest expense item on the government's budget. So that's changed, and they're measuring non-defense government spending. So they're taking that out of the equation. They're taking the military out of the equation. And the non-defense government spending is right around 17.5%. That is actually one of its highest levels. And that's a good thing. See, when the government buys things or finances a state or local government through a grant, that money is spent in the economy, and it's on projects where regular Americans work, and those Americans are getting a paycheck, and they're paying taxes, and they're buying houses, and they're buying cars, and they're buying clothing, and they're eating. Hopefully they're buying clothing. That's a really bad joke. But anyway, you get the idea. The economy grows when the government spends. And by the way, they get their money back relatively quickly, because every time that money changes hands, what happens? When somebody goes to work and gets a paycheck, what happens? They have to pay taxes, right? When they go and buy something from the grocery store, and the grocery store makes a sale, makes a profit, what happens? They pay taxes. So that money actually has a tendency to come back relatively quickly, not immediately, but they get a big chunk of it back right away. So it's a beautiful thing. It works out really, really well, and I'm just really excited about the future of this country. Does that mean that you're not going to have corrections? No, that's just part of being in the stock market. It happens. People get nervous. When they get nervous, they tend to do a lot of things they probably otherwise wouldn't do, like sell all their stocks. You get big institutions, by the way. There's some big institutions around the world. They do the same thing. And many of the times they're forced to do it because individual investors or even corporate investors will pull money out of a fund, which forces them to have to sell to meet the redemptions. So that's the major cause of most corrections. It's actually not what's going on in the world. It's how investors are reacting to it. And I'm here to tell you, I think any reaction that you see over the next 3 or 4 years, you ought to take the opportunity to buy the dip. Buy the dips. I don't care if the dip is 25. If it's 25%, I'm going to take out a loan. I will literally take out a loan. I will literally do that. It's called margin. Now I'm not going to put it all in stocks. I'll hold some high yield bonds. Boy, you want to talk about an asset class. If that would go down 10 or 15%, I'd be all over that. Yeah, and we hold some of those, by the way, and I'm waiting. I'm waiting to add to those holdings because they actually act a lot more like stocks. They move more in line with the stock market than they do the bond market, but they've got a much higher yield than government bonds do. So that's something else that, by the way, at the workshop, I'm going to go fast. I'm going to try to talk for about 45 to 50 minutes. I'm going to cover a lot of stuff, and then we're going to take a little bit of break and come back, and I'm going to answer questions. So that's going to be how that works. Because anybody that knows me knows that I've probably talked too long in the past, and I'm working on that. We've got a lot of really good information, and I'm going to have big handouts this time. So a lot of other stuff that we had talked about. There's a capitalized profits model I want everybody to see. I have to explain that one, by the way. There are a dollar-euro exchange rate. There's a ton of slides that I think are just wonderful that kind of just display the hidden strength that people are not talking about, that they're not being focused on. Their attention's not being focused on. And I don't want them to miss what I really believe is going to happen over the next few years. Over the next few years, I think stocks do really well. I think the international emerging markets, if they catch up to where we are, that's where most of the money's going to be made, or at least an awful lot of it. So if you don't have that included in your portfolio, at least 15, 20% or so. If you don't have that, I think you're going to be missing the boat. So if you come to that workshop, again, just go to bullingtoncapital.com. That's bullingtoncapital.com. Yeah, you can also call us if you don't have a computer, 330-664-0700. That's my office line, 330-664-0700. And feel free to call to sign up for that seminar. And I think it'll be worth your time. Again, there is no cost to attend. Seating is limited. It's Thursday, November 2nd. It's going to start 6:30. Again, we're going to go for a little bit less than an hour, and then I'm going to take a little break, and then we're going to come back, and I'm just going to open it up to questions. I think it's going to be fun. When you get to the website, it's just going to talk about socially responsible investing, which we are going to cover as well. But now that I hear the music, that means they're kicking me out of here. Hey, you've been listening to Bill Bulllington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Feel free to stop by my website, drop us a line, say hi. I'm going to let you guys go now. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bulllington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420 The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bulllington Capital Management, LLC.